Welcome to FailCraft, the podcast where we dive into the messy, real side of success and explore how setbacks become the stepping stones to growth and clarity. I'm your host, Ezekiel Iferia, and today's guest is Michael Newman. Michael is a branch manager and senior loan officer at CMG Home Loans with over 20 years of experience. But he isn't just a numbers guy, he holds a degree in psychology. He understands that our financial decisions are often driven by fear, not logic. He champions the all-in-one loan, a strategy that allows borrowers to stop acting like consumers and start acting like the bank. He's here to talk about why being house rich and cash poor is a trap, the psychology of financial control, and how to rewrite the rule book on debt. So, Michael, I am very excited to welcome you to Fieldcraft. Thank you very much for joining us.
Yeah, thank you. I appreciate you having me today.
It's an honor to have you here. So let's get in started. You argue that the traditional 30-year fixed mortgage, which society views as the safe and responsible choice, is actually a wealth trap. So how is that true? Why do you say that?
Yeah, well, first of all, I want to be careful not to discount the 30-year mortgage. To be honest,
Mm-hmm.
most of us would not be in home ownership. It wasn't for that loan. So, I do the loan all day, every day, and it's very important part of the home buyer process. However, as we progress and we get more financial stability in our life, there's other ways to repay a mortgage. And so, a 30-year amortization and term gives us a lot of, a fixed rate often, and gives us a lot of comfort in the sense that we know what our payment's going to be. And that is very, I guess, again, comforting. But again, as our finances progress, hopefully, and we get wiser with money, paying a mortgage for 30 years costs you an incredible amount of interest. And let's be honest, nobody keeps a loan for 30 years. So really what happens and what we've been kind of convinced of, I think, is we chase around rates. That's the first thing anybody asks me is, what's your rate? When they call me for the first time, what's your rate? We think that's the only thing that we can affect our payments and our payments and all that kind of stuff, our interest rate. And so they ask this question because they don't know really what else is going to affect how much I repay. But the reality is every 3 to 7 years, we're chasing another rate around and we're refinancing or trying to get cash out to pay off the debt we racked up or remodel a kitchen or send a kid through college. And so we get on this cycle, and every time they do that, we end up paying closing costs. And again, I'm a recipient of those, so don't get me wrong, but we pay closing costs, and then most people are talked into resetting back out to 30 years yet again. And if you ever look at an amortization schedule, the first 5 years of your mortgage is almost all interest. Nobody's doing this math, and not many are, anyways, and about this closing costs, resetting, all the interest. It's a cycle of something that it's really hard to get out of. And the reality is the average age of an American right now with a mortgage is somewhere around 54 years old. And on top of that, what really gets scary, and nobody's talking about this, is there's 26 years left on most of those mortgages. And that's thanks to the low, COVID 3% interest rates or wherever they were. Uh, that's wild. That's scary. Um,
Okay, all right, Michael. That was really clear explanation. But I like to know when you sit down with a client and do the math of how the traditional system might actually be feeling them, like you we're just going through for us right now. So, what is usually their reaction? Is it anger, shock, or disbelief, or something else?
yeah, good question. You know, I think it's a mixture of all of the above. I think we've been conditioned to think one way for so long that the realization, when I kind of remind people of how this thing works and what we've been doing, there's a realization, then there's a, yeah, you're right. And then there's this like, gosh dang it, you know, um, yeah, didn't know there was another way, type of thing. And just wasn't ever forced to think about it. So I think there's a mixture of emotions for sure.
All right, all right. So, for you personally, you have a background in psychology. So, why do you think people are attached to the 30-year fixed mortgage? Is it a fear of the unknown, or do we choose that misery we know over the new strategy because it kind of feels safer?
Yeah. So I think, I mean, the biggest thing right now is people just don't know that there's another way. So let's be honest about that. They just don't know yet. And that's my mission, is to change that. But I think we it's very money in and of itself is very psychological. Okay, whether depending on how we were raised, the culture we were raised in, how our parents handled money. Schooling very, very rarely talks about money and how to manage it, and so there's a lot of, depending on where you come from, depending on maybe the era you grew up in, there's these mindsets around whether there was lack, whether there was a lot of lack of prosperity. There's just so many mindsets that are really locked in because of really the way we were raised and just our environment. And so it becomes very psychological. I know that, a lot of times, I talk about price points with people, and obviously as time goes on, I know my parents talk about, when they bought a house for $30,000. Well, that's hard to quantify, but the dollar's not what it was back then either, and everything progresses. You get into talking about a price point of a half a million or even $1 million, and those numbers themselves spoken bring up anxiety and an emotional response to that has really no root in practicality. So a lot of times when I'm speaking with people, I'm making sure that there isn't, dad in their ear from when they were little saying, "Oh, what, you're gonna live in $1 million house," or whatever it is. And it's like, but is that decision not to live in the $1 million house based upon what you can and can't afford, or is it based upon the little voice in your head that is telling you you can't, you shouldn't be able to do that? So I try to really break down people's emotions and separate them as much as I can, and give them practical ways to look at their finances and make sure that they're making their decision based upon them, not anybody else, them, what they're comfortable with, what they can afford. Often those are completely two different things, and we get very, very tied up in the psychology. Not to mention when we start negotiating and people get competitive, right? So you negotiate a price, and all of a sudden, the counter offer comes back, and they don't want to. I don't. No, I'm not going to do that, because you want to win. But But so I try to get people to step back and be like, hey, okay, yeah, of course we want to win. We want to win, but do you want that to get in the way of this place that you really want? And is this $10,000 that's going to change your payment $50 a month? Is that going to make or break the deal? Let's be real. Oh yeah, you're right. So it's a lot of psychology, a lot of emotions.
All right. So, Michael, you now champion the all-in-one loan. So, without getting too bogged down on the technical jargons, just try to make it simplistic. How exactly does this structure work, and how does it flip the script?
Yeah. Good question. So yeah, it's a very dynamic loan. Basically, in a nutshell, it's a checking account that's fully integrated with a line of credit. So your mortgage is now not amortized anymore. It would be revolving, and that's crucial. And so what happens is our money, as it sits in our checking account, what's it do for us today? Absolutely nothing. We need it there so we can deploy it into bills or whatever it may be, right? So, but while it's there, it's not working for us. It's actually working for the bank or savings account. Same thing. It's really not doing anything for us, but we need it liquid so that we can use it for whatever. Well, the all-in-one actually puts that money to work for you. So as soon as your money goes into your checking account, it immediately is pushed to your mortgage balance, and it's paid down immediately. And the magical part of what happens there is as it's paid down that night, interest is calculated. So it's a daily interest calculation based upon a balance that you're driving down with your money. And really the best part is as you do that, you have not tied up that money, meaning it's liquid and accessible. So as you snowball pay off your mortgage, you still have access to these funds, which is huge. So it's really a pretty much set it and forget it. You shouldn't never need a different loan to do some of these things that people call me about, hey, I need to remodel a kitchen, send the kid through school, whatever it may be. And so they have to do a new loan. You don't have to do that in this situation. So saves you hundreds of thousands in interest if you fit, and it makes that money also liquid and accessible for you as you go.
Oh, all right. So, a common failure mode for homeowners is, being cash rich and being house rich rather, and cash poor. They may have they have $1 million in equity, but really can't buy the basic things they need daily, maybe like groceries, if peradventure they lose their jobs. So, do you think liquidity is the ultimate form of financial freedom? And how exactly does the traditional mortgage destroy it?
Yeah, good, really good question. So yeah, I do believe that. Let's be honest. How many people do we know? And maybe it's a listener that has worked their entire life to get mortgage free. Okay, and so that's the goal, is to remove a mortgage, a 30-year mortgage, 15, whatever it is. And so they do this, they accomplish this task, which is a great task and it's amazing. And they go into retirement and now they have Social Security, a little pension, and they're having a hard time, going out to eat twice a week or buying groceries or whatever it may be. So they're really, really, really tight. So they work their entire life to become mortgage free, all to retire and not be able to enjoy retirement. Yet they own this house free and clear. And let's just pretend it's worth $400,000. So you're free and clear. You don't have a mortgage, which is wonderful, but yet you can't live the retired life that you work so hard for and really enjoy it. And you've got this $400,000 asset that's just sitting there. And how do you get access to that? Well, you'd have to sell, but you need a place to live. So there's a conundrum there, right?
Mm.
So with the all-in-one, not only do you expedite, do you potentially, this is not for everybody, but if you if you fit and this works for you, you potentially pay off your mortgage way faster. But at the end of it, now that same situation, let's say it's a $400,000 house, and let's say you pay it off. Again, you're not going to have access to 400,000, but you'd have a line, say, for 300, okay, free and clear. And so you walk into retirement, and now instead of not having access to any of that capital, you now have access to 300,000. So you can use it however you see fit. That's your hard-earned money. So again, you're borrowing it so that as you borrow it. So let's say 500 bucks a month could really change the life in retirement. Well, how long would it take of borrowing $500 a month to equate to 300,000? You're not gonna outlive that. And so that's the freedom that's inside the all-in-one home loan premise, is it really gives you the opportunity to not only control your finances while you're really making money, but have more control over your biggest asset most of us will ever own in our life, giving you access to that. And guess what? You're not getting access to 100% of the value. So you don't have to worry about, inheritance and all that stuff, worried about what you're going to leave for your kids. You're not getting access to 100% of the value of the home. That wouldn't be wise, but there's still a big chunk you are. And I think, at least how I feel about my parents, they should use that. Like, that's theirs. They worked hard. They already raised me. They don't need to leave me, tons of money. I should be earning that on my own.
So, Michael, we often assume that if someone has money, they know how to manage it. But you being the professional, the guy who interacts with everyone from high earners to just average earner and every other person, do you find that do you find that high earners are as susceptible to financial fear as every other person, or do they have a specific mindset that actually distinguishes them?
Yeah, good question. So again, that gets into the psychology, I think, a bit. And yeah, high earners are they believe in their self, they believe in their capacity to earn. They have a higher propensity for risk. They don't, a lot of them are not getting in their own way. Whereas I think some of the opposite end of the spectrum really gets in their own way. There's psychological barriers, and it and there's this imposter syndrome almost, if you will, that just a lot of people just, they feel like I could never do this. There's a lot this the mindset is very skewed towards a negative mindset. And so a lot of what I do is trying to inspire people. Wait a second. Yes, you can. You apt look at what you've done. Look at what you've accomplished. And so focusing, and we all are guilty of this, but focusing on the gains that we have. In other words, how far we've come in our life versus all the gaps, okay? Comparing ourselves to others and all the things that can get in the way of having a really sound mindset of a champion. So the high earners most of the time are very, very they're self-starters. They have a very strong belief in themselves and their capacity to win no matter what.
All right, all right. So, Michael, for the listener in our audience who is sitting on a traditional mortgage right now, paying thousands in interest every month and feeling stuck. So, what's one mindset shift they need to take, they need to make today to take back control of their financial situation?
Yeah, so I think it's really important. That's a tough question to hone in on because there's so many different households and how they're running things. But those that are paycheck to paycheck, my challenge. I mean, there's not a single person that sets in front of me that I can't help them, minimize their budget by 20%. We just overspend. It's the American way. We just do. So that's the first thing is really honing in on a budget and making sure that you're not just wasting money on subscriptions that you don't need, that you haven't used, and all these things that we're all guilty of. So that's the paycheck to paycheck. The folks that have more of a discretionary income, which actually are more guilty of not paying attention to money, as I've witnessed, because they don't have to, because they're comfortable. So they just kind of spend. And so those need the budget just as much. With the premise of the all in one, there is a way to put that extra discretionary money to work for you. And make it very intentional. And when that money is sitting idle, to make it work for you, to save you money so that you can leverage to acquire more assets or just merely pay off a mortgage early.
Okay, all right. So, Michael, after 20 years in the industry, seeing booms and busts and helping clients navigate the psychology of their largest debts. So, I'd like to know, what does being successful truly mean to you now?
Yeah, a lot different than it used to be. Being successful to me, and I think this has always been part of who I am, but is, you know, have I been able to change and impact the lives of the people that I'm working with? Do they walk out the door when they meet with me or on a video call? Do they walk away better than when they came in? Even if it's just a little bit. If I'm doing that more times than not, then that is successful. That's leaving a legacy. And when it comes to, finances and all that kind of stuff, let's be honest, there's never enough money, there's never enough success. There's always somebody that's got more, something better, and that's just such a thief. It's such a thief. So, yeah, it's not about how much I can get, it's about again freedom and having choices. So success and financial freedom is being able to, if I decided that tomorrow I would like to fish in Mexico for the next 6 months, the ability to do that and not worry about it, that's freedom. And so that's and that plays into success.
All right, that's a really amazing measure you've attributed to success, Michael, and thank you very much for sharing it with us. So, lastly, for our listeners who want to learn more about the all-in-one loan or connect with you for a consultation. So where is the best place for them to go?
Yeah, so the best place you can visit my website, which is just newmangroup .com, and then you can reach out to me via email at newmangroup at cmghomeloans.com, or you can call or text our line at 541-227-2727, and we'd love to connect and teach you more.
All right. Thank you very much for sharing that, Michael. It has been a truly insightful conversation with you, and I am very excited and honored to have you on the show today. Thank you very much for taking the time to join us.
Yeah, thank you. I really appreciate the opportunity.